What the is an interest rate? You've heard this name before.
On TV, on the newspaper, from someone you know while buying a house, maybe even in the bank when you buy a house for yourself.
But what's this magical number? What does it mean? Where does it come from? Why does it move up and down? To understand it, imagine this.
Distant relative that you never met just died, and she had no heir to her fortune. Someone calls you and tells you you'll be inheriting $1 million. There's only one little catch. You cannot touch the money for 10 years. You were so excited at first, but now you're sad that you have to wait for 10 years before doing anything with the money. You have a friend that you tell about this and he offers you a deal. He'll give you $900,000 today and he'll have the right to claim that $1 million in 10 years.
What will you say to him? Will you agree? Would you wait 10 years instead? What if he offered you $990,000? What if he offered you $300,000? Well, there seems to be no right answer. It all depends on how much you value your money right now instead of waiting those 10 years.
You might desperately need the money right now and might agree to give him the $1 million in 10 years for $300,000 right now, or you might not want to make a deal unless he gives you the whole $1 million without discussion in exchange.
Well, anyhow, congratulations. You've just discovered what an interest rate is.
Money has different values, not only depending on how much, but also when. This preference is what an interest rate tells us and is the whole base of finance. In the previous example, if you agree to give your friend the right to claim the $1 million for $300,000, you're saying that $1 now is equal to $3.33 in 10 years. So $2.33 more than now. Or said in another way, you're saying that the interest rate for the 10 years is 233%. To practice some more, let's set an interest rate of 10% in a year. What I just said means that $100 now are the exact same amount as $110 in a year's time. The exact same amount. Now, let that sink in, because I know if this is your first time hearing this, it can be a hard concept to grasp, or at least it was for me. Now you understand why they call interest rates the value of money. They're usually set in a yearly rate, so when you hear in the press that the interest rate is 10%, all it means is that it costs $100 today to have $110 in a year.
But we still haven't answered some really important questions. Who sets these rates? What do they depend on? Why do they move?
Well, first of all, there's not one interest rate, but many, and they can be categorized in different types. Usually, central banks control a currency, and they're the ones who set the rates. For instance, the US dollar is controlled by the Federal Reserve, or the Fed for short, and the euro is controlled by the European Central Bank. They move rates up and down to fit their agendas, like controlling inflation or employment, with more or less success. Besides the central bank rates, there's many others like the interbank rates, which is the rate at which strong banks lend money to one another. And this is the one mortgages are tied to.
There's also non-standard rates, like the interest rate you pay for your credit card or your car loan. The world of interest rates is a really extensive and interesting one, no pun intended, and I personally spend my days working with them as I've pursued a career in quant finance, specifically in an interest rates desk. And of course there's many topics we haven't covered in this video, like interest rate curves and financial products like bonds and swaps, mortgages, and if you want to learn about them, let me know in the comments below. But for now, I'll see you in the next video.